Getting to a great idea is hard in college. Nonsensical essays, cringe-inducing presentations, and seemingly unsolvable problem sets. But then, the first thought becomes a final thesis. Jumbled slides transform into a polished keynote, and that midterm assignment gets a lot less mid. Because the road to great ideas is littered with bad ones. You just have to keep going until something clicks. Great ideas start on Mac. Find out more on apple.com/college.
Hey, this is Riley Green, and I'm here to warn you about the dangers of Hey Dude shoes. With their easy on, all-day comfort, you're bound to get addicted, so try them at your own risk. But when you can't wear anything else, don't say I didn't warn you.
Welcome to Learn Finance 101, where we break down the key historical events within finance and economics. This is not just another episode. It is an invitation to slow down, settle in, and truly absorb one of the most important, yet often underappreciated, revolutions in the history of finance: the rise of passive investing and the index fund. Today's story is not about overnight fortunes or catastrophic losses. It is about a simple, almost radical idea that quietly dismantled an entire industry's business model, saved trillions of dollars for ordinary people, challenged the myth of active manager genius, and fundamentally changed how capital is allocated across the planet. It is the story of a man named John Clifton Bogle, a handful of academics who proved markets are harder to beat than anyone wanted to admit. A few skeptical institutions that took a chance, and eventually a tidal wave of evidence and investor behavior that made passive investing the default choice for most of the world's capital. This ultra-extended edition will take us on a slow, thorough, almost meditative journey. From the intellectual origins of indexing in the 1950s and 1960s, through the birth of the first index fund in 1976 and the decades-long battle for acceptance against the hostile Wall Street establishment, through the explosive growth of index funds and ETFs from the 1990s to the 2010s, through the dominance of passive strategies by the 2020s, through the controversies and criticisms that still swirl around indexing in February 2026, and finally, through the profound ways this quiet revolution has changed investing forever, for better, and in the eyes of some critics, for worse. We will linger on the human side, Bogle's personal struggles, the skepticism he faced, the quiet satisfaction of ordinary investors who benefited, and on the broader implications for markets, corporations, and society. Let's begin by stepping back into the academic halls, trading floors, and investment committee rooms of the 1950s and 1960s, when a small group of economists and mathematicians began to question the very foundation of active investing. For most of the 20th century, the prevailing wisdom in finance was straightforward and seductive. Skilled stock pickers, research analysts, and fund managers could consistently outperform the overall market. The assumption was that markets are inefficient, prices do not always reflect all available information, and therefore a smart, diligent professional armed with proprietary research, intuition, industry contacts, and discipline could identify undervalued stocks, avoid overvalued ones, and generate superior returns for clients. Mutual funds, hedge funds, pension funds, and active managers charged high fees, often 1 to 2% of assets annually, plus performance incentives, on the promise that their expertise would more than pay for itself. This belief was so deeply ingrained that it was rarely questioned. Wall Street thrived on it. Brokers, analysts, and portfolio managers were paid handsomely for their supposed ability to beat the market. The narrative was reinforced by anecdotes of legendary investors, Benjamin Graham, Philip Fisher, and later Warren Buffett, who appeared to consistently outperform through careful security selection. The mutual fund industry grew rapidly after World War II, promising professional management to the growing middle class. Then came a series of academic breakthroughs that would eventually turn this belief upside down. In 1952, a young University of Chicago graduate student named Harry Markowitz published his doctoral dissertation, Portfolio Selection, in the Journal of Finance. Markowitz introduced modern portfolio theory, showing mathematically that diversification could reduce risk without sacrificing expected return. He demonstrated that the risk of a portfolio is not simply the sum of individual.
Getting to a great idea is hard in college. Nonsensical essays, cringe-inducing presentations, and seemingly unsolvable problem sets. But then, the first thought becomes a final thesis. Jumbled slides transform into a polished keynote, and that midterm assignment gets a lot less mid. Because the road to great ideas is littered with bad ones. You just have to keep going until something clicks. Great ideas start on Mac. Find out more on apple.com/college.
Hey, this is Riley Green, and I'm here to warn you about the dangers of Hey Dude shoes. With their easy on, all day comfort, you're bound to get addicted, so try them at your own risk. But when you can't wear anything else, don't say I didn't warn you.
Stock risks, but depends on how those risks vary. The efficient frontier, the set of portfolios offering the highest expected return for a given level of risk, became a cornerstone of finance. Markowitz's work earned him the Nobel Prize in Economics in 1990, shared with Merton Miller and William Sharpe. In 1964, William Sharpe, building on Markowitz, introduced the capital asset pricing model, CAPM. Sharpe argued that the only risk worth compensating investors for is systematic market risk, the risk that cannot be diversified away. Idiosyncratic risk, company-specific risk, can be eliminated through diversification. Therefore, the expected return of any asset is determined by its beta, sensitivity to market movements, plus the risk-free rate. CAPM implied that active managers could not consistently beat the market after fees, because any outperformance would come from taking on undiversifiable risk, not from skill. Then came Eugene Fama. In the late 1960s and early 1970s, Fama and his colleagues at the University of Chicago developed the efficient market hypothesis, EMH. The strong form of EMH posited that prices fully reflect all available information, public and private, so no one can consistently beat the market. The semi-strong form said prices reflect all public information, so fundamental analysis cannot consistently outperform. Even the weak form suggested that past prices cannot predict future prices, undermining technical analysis. Fama's work earned him the Nobel Prize in Economics in 2013, shared with Robert Shiller and Lars Peter Hansen. The most damning evidence, however, came from real-world data. Studies in the 1960s and 1970s showed that the vast majority of active mutual funds underperformed simple market indexes after fees. Michael Jensen's 1968 study found that, on average, mutual funds delivered returns no better than a random selection of stocks, and far worse after accounting for management fees and trading costs. By the early 1970s, the evidence was mounting. The average active manager could not beat the market net of fees. Enter John Clifton Bogle. Born on May 8, 1929, in Montclair, New Jersey, Bogle grew up in a family that lost much of its wealth during the Great Depression. He attended Princeton University on scholarship, graduating magna cum laude in 1951 with a senior thesis on mutual funds that caught the attention of industry leaders. The thesis argued that mutual funds were not living up to their promise of superior performance. In 1951, he joined Wellington Management Company, eventually rising to chairman. But in 1974, after a bitter boardroom battle over investment strategy, Bogle wanted to keep costs low and focus on long-term investing, while others pushed for aggressive growth. He was forced out of Wellington. Rather than retreat, Bogle founded the Vanguard Group in 1975, naming it after the British naval ships that led the line of battle, symbolizing his determination to lead a new approach. He convinced Wellington to spin off Vanguard as a client-owned mutual company with no external shareholders, a structure that aligned the firm's interests with those of its investors. Bogle's big idea was radical for its time. Instead of trying to beat the market through active stock picking, simply own the entire market at minimal cost. On December 31st,
Getting to a great idea is hard in college. Nonsensical essays, cringe-inducing presentations, and seemingly unsolvable problem sets. But then, the first thought becomes a final thesis. Jumbled slides transform into a polished keynote, and that midterm assignment gets a lot less mid. Because the road to great ideas is littered with bad ones. You just have to keep going until something clicks. Great ideas start on Mac. Find out more on apple.com/college.
Hey, this is Riley Green, and I'm here to warn you about the dangers of Hey Dude shoes. With their easy on, all day comfort, you're bound to get addicted, so try them at your own risk. But when you can't wear anything else, don't say I didn't warn you.
1975, Vanguard launched the first index investment trust, later renamed the Vanguard 500 Index Fund, the world's first retail index mutual fund. It aimed to track the S&P 500 with a tiny expense ratio of 0.43%, later reduced dramatically. Wall Street ridiculed it as Bogle's folly. The initial offering raised only $11.3 million, far short of expectations. Many called it un-American to settle for average returns. Critics said it would never attract meaningful assets. Bogle persisted. The fund grew slowly at first. By 1982, it had $100 million in assets. The real acceleration came in the 1980s and 1990s, as evidence mounted that active managers could not consistently outperform. Academic studies, Morningstar data, and S&P's SPAVA, S&P indices versus active, reports showed year after year that most active funds lagged their benchmarks after fees. Bogle's mantra, don't look for the needle in the haystack, just buy the haystack, began to resonate with institutional investors and eventually with individuals. The ETF era turbocharged passive investing. In 1993, State Street Global Advisors launched the first ETF, the SPD RS&P 500 ETF SPY, trading on the American Stock Exchange. ETFs combined the low-cost indexing of mutual funds with intraday trading, tax efficiency, and transparency. By the late 1990s and early 2000s, ETFs exploded in popularity. Vanguard entered the ETF space in 2001 with its Vanguard Total Stock Market ETF VTI. BlackRock's iShares and Invesco QQQ followed. By 2026, global ETF assets exceed $15 trillion, with passive strategies, index funds plus ETFs, accounting for over 50% of US equity assets under management and approaching 40% globally. The impact has been profound and multifaceted. Fees have collapsed from 1 to 2% for active funds in the 1980s to 0.03 to 0.10% for broad market ETFs today. Trillions of dollars have been saved in fees, flowing directly to investors in the form of higher net returns. The shift to passive has democratized investing. Anyone with a brokerage account can own the market at near zero cost. It has also changed corporate behavior. Index funds, as major shareholders, vote on governance issues. influencing boards and executives on matters like executive pay, climate disclosure, and diversity. But passive investing is not without criticism. In 2026, debates rage on several fronts. First, market concentration. The S&P 500 is now heavily weighted toward a few mega-cap technology stocks. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and others. In 2025 to 2026, the top 5 stocks account for nearly 30% of the index, the highest concentration in half a century. Critics argue that passive flows mechanically push more money into already large companies, inflating valuations and creating fragility if sentiment shifts. Second, price discovery. If everyone indexes, who sets prices? Traditional active managers argue that indexing relies on their price discovery function. Without active trading, markets could become less efficient, more prone to bubbles, and slower to reflect new information. Third, systemic risk. In a downturn, widespread.
Getting to a great idea is hard in college. Nonsensical essays, cringe-inducing presentations, and seemingly unsolvable problem sets. But then, the first thought becomes a final thesis. Jumbled slides transform into a polished keynote, and that midterm assignment gets a lot less mid. Because the road to great ideas is littered with bad ones. You just have to keep going until something clicks. Great ideas start on Mac. Find out more on apple.com/college.
Hey, this is Riley Green, and I'm here to warn you about the dangers of Hey Dude shoes. With their easy on, all-day comfort, you're bound to get addicted, so try them at your own risk. But when you can't wear anything else, don't say I didn't warn you.
Selling by index funds could exacerbate declines. During the March 2020 COVID crash, some pointed to passive outflows as amplifying volatility, though evidence is mixed. Fourth, active resurgence. In volatile or thematic markets, for example, AI, energy transition, geopolitical shifts, select active managers have outperformed in recent years. In 2025 to 2026, some data shows active funds beating benchmarks in certain sectors, fueling a modest revival of active strategies among sophisticated investors. Yet the evidence remains overwhelming. The average active manager still underperforms after fees over long periods. SPIVA reports show that over 15-year horizons, 85 to 95% of active funds lag their benchmarks. Bogle's simple idea has proven remarkably resilient. John Bogle, who died on January 16, 2019, once said, "The miracle of compounding returns is overwhelmed by the tyranny of compounding costs." His revolution proved that simple, low-cost, patient ownership of the market often beats the search for genius. In February 2026, passive investing is no longer a fringe idea. It is the default for most investors, from individuals to the largest pension funds and sovereign wealth funds. The rise of index funds did not just change investing, it changed the very nature of capital allocation, democratized markets, forced an industry to confront its own value proposition, and created a more efficient, but potentially more concentrated financial system. Bogle's legacy is not one of dramatic flair, but of quiet persistence. He did not invent a new asset class or a complex derivative. He simply reminded the world that the market itself is the best investment most people can make, and that trying to beat it often costs more than it's worth. Thank you for listening to this episode.